Now, I think, Josh, you have more fundamental question here. And that's why, it's not a technical question. How do you get this chart? It's not that. It's about why do you get this chart? Right. And so let me explain it to you. So you need basis as a sufficient condition for investment, right?
Right.
Okay. So, and I would like to also make sure that you get the full picture of it, because when we're at different relevant areas, we address those questions. Now I'm going to give you a complete picture of it, because there might be some gaps in different places. When you do, this is asset management, okay? The whole thing that we are doing is asset management analysis. So you decide what to invest in. And one of the ways that we do all the time is fundamental analysis. Is it worth investing? Anything that that you take an asset, whether it is a stock or a bond, now options and futures and so up, you ask whether this is worth taking. So to do that, you know that you have to use some fundamental models. Like for stocks case, it is a dividend discount model, and you find out its worth, and you look at the worth at the market. If the model gives you $25, market says $24, you say market is undervaluing, so you buy it. So that's for stock. Same for the bond. You do the present value of the coupons and the par. And again, same thing, whether this is fairly valued, undervalued, or overvalued. So again, you decide whether to take the assets. Option pricing model, you are introduced to Black-Scholes Martin option pricing model. Again, the same stuff. If the option pricing model says it is $4.50 and the market says it is $4.20, then you say it's worth buying. Okay?
Okay.
Go to the futures now. Futures has the model, cost of carry model. You look at the cost of carry model again. These are all fundamental stuff. If you want to think about fundamentals, it has to have an equation. And in an equation, there is a left-hand side and the right-hand side. And you look at the futures is equal to cost of carry model. And then again, if you find out the futures to be undervalued, that means there is a right-hand side is the spot market, left-hand side is the futures market. If it is undervalued, then you buy futures. So those done, right? In swap also there is fundamental models for swap as well. Now it is done. In addition to that, and these are all done in different places in finance curriculum. Like in investments, you have stressed, first of all, in managerial finance, the basic course, you have looked into it and looked at various models. Like I'm pretty sure you'll remember that in finance class that you had to do the dividend discount model, then yield to maturity, all those stuff, right?
Yes.
Not so much in derivatives, little bit maybe, flashes of it. And so then when you come to the derivatives class, the central contribution of derivatives class is that can derivatives help in asset management? Obviously, derivatives can help in terms of risk minimizing, because this is a risk minimizing tool, right? The genesis of the birth of derivatives is that we needed a risk management tool. Think about this soybean producer again. That is, soybean producer look at the price uncertainty and decide not to produce because he is afraid the price will go down by the time he cultivates, right? So it is making sense. So far, whatever I'm saying is sinking well, right? Correct? Yeah. Okay. So now, so you say, well, is there any way that spot is not affected by this soybean producer's decision. So you say, yeah, let us enable the spot market. How? Give a futures to it. So he goes for short futures. The other guy takes the risk that it is going to go up in price, and that farmers believe it is going to go down, so it shorts, and then market is now supplied with soybean, right? So derivatives came as a risk management tool. Then suddenly we decided that, well, so right now you say that I will invest in stocks and bonds, but I will also take position in options and futures and swap to minimize the risk. So as a risk management tool, it has become a part of your portfolio, but not as an asset by itself, but as a risk management tool. So then derivatives have generated another fundamental model by itself, and that's called normal backwardation and contango market. You see the story here so far, the evolution?
Yes.
Okay. So what happens then is that in a normal backwardation market, there are two conditions. One is known as necessary condition, which has two parts, and the other is sufficient condition, which is basis.
Mm-hmm.
So in a normal backwardation case, the classic case is that if you identify the market in the necessary condition,
Mm-hmm.
then it will say that this is normal backwardation. But once you do that, you say that let me look at the stability of this market. And in the stability of this market, you say that if the basis is downward sloping, then don't hedge. And the flip side is that if your risk tolerance allows you, you can invest. So now you see, fundamental analysis gives you the same thing, demand and supply basis, that whether you should get EEM or whether you should get EMB. But then in using derivatives, you can get another fundamental recommendation. That is, yes, go long. When? It is normal backwardation and downward sloping, right? The thing that MG did, go long with the futures, right? Remember, MG
Right. Yeah.
go long, and they had short forward because that guarantees a price for them and for supplying the crude oil. So with that, we say that, well, now we have two fundamental models, one based on equations, demand and supply equations, and then you generate a recommendation for the asset to be included or excluded, or included on the short side. And then on top of that, normal backwardation fundamental models or backwardation and contango fundamental models will tell you exactly same thing. So that's that. Now, when you have chosen those assets already, so far you have chosen those assets. Only thing is this, I limit you to these two assets. You need to verify whether those assets need to be taken, and if so, whether on the long side or short side or not at all. So you have already on your individual report. By the way, Nasif, I was also telling Joshua was saying that, can you extend this deadline? I said, certainly I can. And then as well as I'm going to extend the deadline for individual ones where you may want to, you have done both of them done well, but this is not about your grade only. This is your understanding of it. Right. You can go in and improve it with this understanding whether we should go long. And this go long or go short will come from fundamental demand and supply analysis and fundamental normal backwardation and contango analysis. That should come through those models. And technical analysis is not a fundamental analysis. It's about, as I say this time and time again, that if I look at a chart without knowing the header, a technical analyst can do a brilliant job to say whether is this the right time or wrong time to go. So technical analysis is not a fundamental analysis. It is not an intentional. You cannot, if you intend to get a direction for asset inclusion, this is not the right thing. Even though you will hear from your friends, those who do not get into finance well, they would like to use this model to go in and out, but we never recommend that. And so we say, test out whether you have decided that go long. Now you test out whether this is the right time to go. So please make sure technical analysis should be just about the wind. And then,
sorry.
Yeah,
a quick question about so you're saying that the fundamental analysis, under the fundamental analysis, I identify, if the market is backwardation or normal contango, and based on that, based on the sufficient condition, we decided we have to go long or short. So on the technical analysis, like what exactly are we looking at as an investor? Like
you are looking at the market timing. It's not market entry or exit. It's market timing. That means, can I time the market? I have decided that we'll go long or go short. That is done. Previously, I used only basic fundamental model. Now we are going to have basic fundamental model and derivatives fundamental model. So with those two, I have decided. So technical analysis cannot say anything about that. It can only say, is the wind in favor of you? So I give you a very classic example. Sometimes dollar gets overvalued, sometimes undervalued, right? Because this is a competitive world. And when Federal Reserve looks at the dollar and finds out that dollar is overvalued, it has implications, right? That is, people will not buy from us because dollar is so expensive, right? They're not going to import our goods will be very, very pricey for them. So Federal Reserve says, well, we need to adjust the dollar. They used to be a big player. Now market is multi-trillion-dollar market. And so they say, okay, let us wait. We have done our analysis, fundamental analysis. The dollar is overvalued. We are not going to go in and supply the dollar at this point because that market is going to wash it away. So they wait until they see that this is the right time. So when they see the wind is for them, they go not only themselves, Federal Reserve not only goes by themselves, but also they talk to Bank of Japan, Bank of England, Eurobank, that, well, I'm going in. So they all supply dollars there. And then dollar goes down in a hurry. So this is, we say, leaning with the wind and leaning against the wind. So they find out the wind and they lean with the wind. So technical analysis is to find out, is the wind for you at this time? Can it back it up at this time? Nasif, did I make it clear or?
Yes, I'm guessing that's why we do the wind analysis under technical analysis, just to know which way the market is leaning.
Yeah, whether this is the right time to enter.
Mm.
Enter on the long side or on the short side. Okay. Now, you have done your individual analysis already, right? You have done the fundamental models, and then you have done the derivatives fundamental models and technical analysis, all of those. And then you decide that I'm good. We are going to go for EEM and EMB. Okay, that's done. Now, is there any necessity to do the modeling again, Josh?
Can you repeat the question again, Professor?
I mean, you have done fundamental analysis, the spot fundamental analysis.
Right.
You have done derivatives fundamental analysis. And now question to you is, you are doing the group analysis.
Right.
In the group, both have entered in a portfolio. EMB is recommended, so is EEM.
Mm-hmm.
Now, what you need to do is to make sure whether in a portfolio they are safe. And to do that, do you have to do the fundamental analysis again?
I believe yes. I will say yes.
Why do you think so, Josh? Can you convince me?
I think it's because even though they are like, let's say if one is saying to one is like going per se like how to explain it, like let's say EEM is saying it's in a very good condition, it should hedge, giving everything is in like upward slope. However, if the EMB isn't, I think I think that after you combine those two datas, um, like we should be looking at those two synergy of two
Yeah,
companies.
that part is okay. My question is addressed like this. Remember, as a portfolio manager, I said he is actually a glorified chef.
Right.
So a glorified chef is given the ingredients. You can see this on the countertop.
Right.
And you gave EEM and Josh gave EMB. So now he looks at it and say, okay, I'm going to cook a high risk diet. That means I will make sure that it is high risk, high return. Or he might say, I'm going to cook, I'm talking about the menu of the portfolio, the chef,
Okay.
high risk, high return diet. Then another is balanced diet and not so high, not so low return. And the other last one is that low risk, low return. So you need to find out what that case is. Is it high risk, high return, balance, or is it low risk, low return? So to find that out, you mix it. You mix it in the right proportion. I said, I am not going to ask you to do various kinds. I suggest equal participation, EMB plus EEM. So no asset model anywhere, whether it's a spot asset model or derivatives asset model, no asset model anymore. It has been done. It is sitting on the countertop. Now, as a portfolio manager, you are no longer asset manager. You are a portfolio manager. As a portfolio manager, you will see how it is working out. So if you put them together and it is upward sloping, that means together they have synergy, the word that you used, right. Synergy, and together they are going to have high return. And then if it is a straight line, that means they have a balanced portfolio. If something happens to EM, EMB is going to balance it. And then the last one is downward. That means together, they create a negative return. So once you find that out, which how they are going to do, it is simple that analysis as a portfolio, not as an asset manager.
Okay.
So portfolio manager, you just say, okay, I have this curve and it tells me, let's take the one that needs a little bit more work, that is downward sloping. That means we have to make sure there is a hedge in place. We have the portfolio, but the portfolio is susceptible to low return. So we need to hedge. So that is the part. Josh, did I answer your question? That means.
Yeah. No, I think you did. But I was yeah. Prior to this asking this question, I was more I was it was more about like how do I get the graph, but I think you hit the point where I was not understanding things kind of correctly. So
Right, and then this is remember, I think best said would be that you cease to be asset manager at this point in time. So no spot fundamental models need to be done. No derivatives fundamental model need to be done. It's all about portfolio. So I mean, and that is what you guys know that well. We have now partnered with CME. Have you heard this news?
Oh, I haven't, no.
no, yeah, no,
Okay. I mean, I had been doing this for a long time, and CME gave us grants along the way. We created trading room, and then we created the student managed hedge funds. And now I wanted more from them. I said that, well, in a curriculum where I am using lots of stuff on derivatives, so I went to CME and say that in my syllabus, I will follow certain things from CME. If you go to CME websites, there are a lot of education materials, which is going to help me in my course, but I will, after I go through them and they pass the test and so forth, I will certify that they can get a certificate from CME group. So what happens now, you get the degree, but also with the degree, you get the certificate from a flagship organization. So we have concluded that. So this is the new model of curriculum that is coming forth. It is no longer just get the certificate and get the job, or it is just that get the degree. I say, no, it is degree and certificate together. So the reason I'm bringing this up, and it will be from fall, and then there will be 2 courses in these derivatives, and we'll separate this out. In one course, it is learning about just fundamental models. In another course, it will be application of these fundamental models. So you will see that in future, people will get 2 courses for what we are currently doing just 1 course. And so student managed hedge fund would be the other course, the application part of it. So we are glad. And we are a CME group, you know, that how branded they are, right? If you talk about derivatives, they are the derivatives people, and they rule the world. And so when we went there, and I proposed that, it was an uncharted territory for them. So they had been supporting big universities here, Northwestern University of Chicago, Loyola, DePaul, and others, and then us. And now it is us first who have created a partnership with them in the matters of curriculum. And I'm sure big guns will follow through, because they know, now it has become a chartered territory. So people who are coming in future will get there. And don't forget that your individual PowerPoint that you created, and you will have other opportunity to improve and make sure that the story follows. The story that I gave you follows throughout your PowerPoint. As is, you've done well. And but it would be for your own knowledge, so that when the PowerPoint, if somebody says that, well, have you done asset management? Then you said, I can show you. And then a little bit of a portfolio management at the end. I have a question for you about the mindset analysis. Do you have any problem with it?
So the mindset analysis, we finally got access to it.
Yeah.
I still haven't. I still haven't had the chance to like watch your complete lecture on it. But I'm assuming that you want us to add couple slides on mindset too.
That's it.
Okay.
Because this is another area. It's a vast area. I just, as a teacher, I would like to make you aware of this area. That is, let's say Josh and you are both trained with the same materials. Now, both of you look at the same data. And Josh says, go long. Mm-hmm. Is it possible Nasif can say, go short? Same data.
Yeah, that's what happens exactly on the previous assignments.
Right. With the three products S&P, where we need to evaluate if it's like normal backwardation or contango, I think me and Nasif had the different perspective. So I will say yes.
Yeah. So what is doing this? The data is the same. Modeling is the same. It's just the same, the age-old example. You have a glass with half the mark. And Nasif is saying that it is half full. The other, Joshua is saying, is half empty. And if Joshua says half empty, will he be bullish or bearish? Bearish. And then Nasif says it's half full, will be bullish. Right? So what is that element that's driving it? It is something within your mind. It's about your psychology. And it's about your behavior. And that is the thing that has grown over the years, behavioral finance. And Kahneman is the person, he's a psychologist. He got an economics Nobel Prize for this. Can you believe that? An economist did not get a Nobel Prize for behavioral finance. Later on, Professor Kyle got one, but not the initial one. So it was the same stuff. That is, we, according to our psychological or our risk tolerance has something to do with it. We say that, well, the mindset needs to be incorporated. So basically, in my video, I brought in some usual mindset handicaps, or what we call heuristics, that we might have. We may be, these are very, very popular ones. Popular means it happens every time. Panic. Are you panic buying? When you did buy everything, did you check that whether you are doing it through panic? That's one. Then we talked about two other things, and those are basically saying that, are you anchoring? That means I bought, it's so kind of funny and some kind of sad. I had students a long time back. They were saying that, well, their parents bought Lucent. Lucent was a part of AT&T at some point, and it was going through the roof. And they bought the stocks, and then when Lucent was becoming a failure case, then it was going down. Still, they were not selling. Why? They anchored that. Let's say they bought it at $75. They said, no, I will not sell it because it has gone down below 75. And then stories continues and say that they sold it when it was 37 cents. So are you handicapped by anchoring? So there are just few, but they list about 157 biases we have. Okay, so I just wanted to make sure that, well, you are taking this decision bias free. And I call this that inner risk management. You can be danger to your own investments. Do you agree?
Yeah, absolutely.
Yes.
And that's what I'm bringing to fore. And I said, bring any example from the world. Doesn't have to be in finance. If it is in finance, great. That how winners are made, regardless of the profession. It can be law enforcement, like you folks, or it can be healthcare, it can be finance, it can be basketball, it can be anything. But winners are the same people. They have this inner risk management. I mean, when you go out on your mission, if panic enters, your judgment will be clouded with risk. Right? I'm sure you talk about this in your own internal training.
Right. Yeah, absolutely.
Yeah. So they call it in different semantics, but it is the same stuff. That is, regardless, yeah, you are prepared. You have your guns, you have your backup, you have your network, you are all those sort of things. But after that, make sure that you are not danger to yourself. So no more than two slides. If you want to do more, fine. But there is 2 slides are plenty.
And Professor, for the group one, I know that we are doing the portfolio, right? Which is going to be two or three more slides. But do you want us to merge both of our presentation, individual presentation?
Yes. And regardless of the order, but usually, the way we do it, usually, but it is conventional. That is, when we talk about bonds, when we talk about equities, which do you think people know more?
Equity?
Hmm?
The equity or
Equity, right? It's Dow Jones going up and down and all those sort of things. I mean, everybody knows about stocks. However, bonds are market capitalization. Bonds are more because equities, they feel ownership. So if you are holding a stock in Amazon, you feel you're owning Amazon.
Mhm.
And so the bonds similar, but you are not owning it. This doesn't give you the ownership. But of course, you have a stake in the company when you have Amazon bond. So in that case, I would say that, well, put EEM first, then EMB later. But it's your choice. I mean, yeah.
And you said you're gonna extend the deadline, right?
Yeah, both for individual as well as for group.
Thank you.
By 2 days, right? That's what.
Right, right. Just we're back on the 12-hour schedule with no day off. I just need like one day with like Monday or something just to finish it.
I mean, because, yeah, Josh has already told me. Yeah.
Thank you. I appreciate it.
Okay, sure. So Josh left. So
Thank you, Professor.
sure, and good luck. And don't tell Josh also that do the evaluation. Otherwise, it will be zero.
I got it. He just texted me. His internet got disconnected. He didn't want to like.
Oh, okay, okay. Sorry. Okay, okay.
Thank
Bye.
you.
Okay, thank you. And by the way, this is our last office hour, though, right?
Yes. Yeah. This is our
Yeah.
last office hour.
Yeah. Okay. All right. Take care.
Thanks, Professor.
Bye.